Have you ever wondered how a brilliant idea, maybe one that started on the back of a napkin, turns into a massive company that gets listed on the stock exchange? It's this incredible, high-stakes journey that almost always happens completely behind the scenes. So today, we're going to pull back that curtain and unpack the whole thing. The world of pre-IPO investing.
Right? It's really the central question of modern business. We see these giant companies just appear, seemingly out of nowhere. But the reality is it's a long, very calculated process that, by design, happens way outside of the public eye, often years before most of us even hear their name.
And that whole transformation, from a private dream to a public powerhouse is powered by one single thing: capital. It's the cash, the fuel in the tank. It's what's needed to hire people, build things, market a product, and ultimately to scale that tiny idea into a real, functioning enterprise. To really get how this all works, let's follow the journey right from the very beginning, from that first little seed of an idea. So, let's meet our founder. We'll call her Sarah. She has this amazing dream to build a baking empire, but, dreams need cash. So her very first investors, they're usually the people who believe in her the most, her family and friends. This first bit of money is what we call seed funding, and it's the absolutely critical cash that gets her little bakery off the ground. But pretty soon, her bakery is a huge hit. I mean, people are lining up down the block. She needs to expand, and way faster than her initial funding allows. Family and friends did their part, but now it's time to bring in the pros. And this next stage brings up a really key legal term: accredited investors. Now, what does that even mean? Well, essentially, these are people or organizations that regulators say are sophisticated enough and wealthy enough to understand and handle the high risks of investing in private companies. It's really a way to protect everyday folks from losing their shirts on these risky bets. So, because they have this financial cushion to take on bigger risks, these investors get exclusive early access to really promising companies, just like Sarah's. They're this critical bridge, right? They provide the serious capital needed to grow beyond that initial seed stage long before the company is ready for the real major league. All right, so with the business exploding, Sarah needs to scale up in a massive way. And this brings us right to the heart of our explainer: the huge investment round that happens just before a company even thinks about going public. Now we're in the big leagues. We're talking about venture capital firms, VCs, and private equity, or PE, firms. These are serious institutions. They're not investing thousands anymore, they're investing millions of dollars. And in return, they often get a seat on the board and a lot of say in the company. What they're really doing is making a massive, calculated bet that the company's value is going to skyrocket when it finally goes public.
This is their whole mindset, right here. They see this enormous potential, and they're buying a piece of the company now, while it's still private, because they believe those shares will be worth a whole lot more during the initial public offering, the IPO.
But, and this is a huge but, this is a high-stakes game for a reason. It is absolutely not a sure thing. So let's look at the very real risks these investors are taking on, because believe me, it's not all just guaranteed profits. Okay, so investors face two giant risks. First, and this one's pretty obvious, is total loss. The company could just fail. And if it does, that entire investment, it's gone. Poof, vanished. The second risk, and this one's more unique, is something called illiquidity. It means their money is completely tied up. They can't just wake up one day and decide to sell their shares. Think about it like this. Public stock, say shares in Apple, is liquid. You can go sell those shares pretty much anytime the market's open. It takes seconds. But pre-IPO shares in Sarah's Sweets, those are illiquid. That money is locked in tight, sometimes for years, just waiting for a very specific event that can finally turn those paper shares into actual cash. So after all that risk, all that waiting with your money locked up, how do these investors actually get their payday? Well, this is the moment where all that patience can finally be rewarded in a big, big way. So this payday is called a liquidity event, and it usually happens in one of two ways. The first is the famous IPO, where the company finally lists on a public stock exchange like the NASDAQ. The second path is an acquisition, where a much larger company just comes in and buys the whole business outright. In both scenarios, those private shares that were once impossible to sell are finally converted into cold, hard cash or public stock. But hold on, even after a successful IPO,
the wait isn't quite over. There's usually something called a lockup period. It's typically 90 to 180 days where those early investors are actually prevented from selling their new public shares. This is done to keep the stock price stable and prevent a huge sell-off right after the company launches.
So there you have it. That's the pre-IPO journey in a nutshell. It kicks off with the seed of an idea funded by love and belief from friends and family. It starts to scale with professional money from accredited investors. Then it gears up for the big time with a massive bet from VCs, who then have to navigate years of risk and no liquidity, all for that one final game-changing payoff.
So the next time you see a hot new company just explode onto the stock market, you'll know. You'll know about the incredible journey of patience, risk, and high-stakes belief that happened for years behind the curtain. It really makes you wonder, doesn't it? What dream's being funded right now, just waiting for its moment to change the world?